Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for the final time this week. It's Friday the 8th of September. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China has ordered officials at central government agencies to not use iPhones and other foreign branded devices for work. Employees at some Chinese central government regulators received instructions to stop bringing such gadgets into the office, according to the Wall Street Journal. And Bloomberg News reported Thursday that China plans to expand the ban on the use of iPhones in sensitive departments to government-backed agencies and state-owned enterprises. Apple dominates the high-end smartphone market in the country and counts China as one of its biggest markets, relying on it for about 19% of its overall revenue. China reported Thursday another monthly decline in imports and exports, albeit less steep than expected. Exports from China dropped 8.8% year-on-year in August after a 14.5% plunge in July. This was the fourth straight month of decline in exports amid weakening global demand. And imports to China declined by 7.3% year-on-year in August, compared with market estimates of a 9% drop and after a 12.4% plunge a month earlier. Imports have now fallen every month in 2023 from the year-ago period due to persistently weak domestic demand. President Joe Biden aims to seize on the absence of Xi Jinping and Vladimir Putin at this week's Group of 20 Leaders meeting in New Delhi to make fresh inroads with countries that China and Russia have previously courted. He hopes to forge closer ties with nations such as Brazil, South Africa, Indonesia and summit host India that are eager for closer ties with China and have declined to take sides after Russia's invasion of Ukraine. Eurozone growth was weaker than initially estimated in the second quarter, according to revised official figures from Eurostat, the EU's statistics office. Eurozone GDP expanded just 0.1% Q-on-Q in the 3 months to June, revised lower from initial estimates of a 0.3% gain. And growth in Germany, which is the Eurozone's largest economy, stalled, and industrial production fell 0.8% there, hit by a sharp decline in car making. On today's programme, I'm joined by John Schofield, Managing Director of Tempus Investments, and Sunil, Kashyap, Director of Finmet. With a view from Australia is Toby Lawson, CEO at Statton Partners. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com, where you'll also find my daily newsletter with a lot more information on today's business and finance stories from around Asia. US equities tilted to the downside Thursday, with tech stocks leading the declines on reports that China plans to expand an iPhone ban to include state-owned firms. Shares of Apple fell almost 3% following a 3.6% fall on Wednesday, its biggest two-day drop this year, that has wiped off more than $200 billion from its valuation, leaving it with a market cap of $2.78 trillion. The stock, which has a large weighting in US indices, helped push the Nasdaq Composite Index down for a fourth consecutive session. It ended the day 0.9% lower at 13,749. The S&P 500 slipped 1/3% to finish at 4,451. The Dow, though, added 58 points or 0.2% to settle at 34,501. Treasury yields moved lower after a surge on Wednesday in reaction to stronger than expected services data. The 2-year yield fell 8 basis points to 4.95%, giving up Wednesday's gains, while the 10-year was down 5 basis points at 4.25%. Bets that the resilient US economy will give the Fed room to tighten policy further has put the US dollar index on track for its 8th consecutive week of gains, which will be its longest winning streak in data going back to 2015. The index rose 0.2% to above 105, and the PBOC moved to stabilise the weak yuan as the central bank set the daily fixing at a stronger than expected level for a record 54th straight day on Thursday. The currency hit a 16-year low of 7.3287 renminbi in Shanghai. In offshore markets, it broke below 7.34 renminbi to the dollar, trading as low as 7.34 and a quarter. Hong Kong's Hang Seng Index fell for a third day, shedding 248 points, or 1.3%, to a 6-week low of 18,202. The Hang Seng Tech Index was down 2%, and on the mainland, the Shanghai Composite lost 1.1% to 3,122. Chinese property developers saw extreme volatility as investors speculated about further real estate policy easing measures from Beijing. China Evergrande surged almost 30% at one stage after skyrocketing nearly 83% a day earlier, but it gave up all those gains to close the day flat. Sunac China jumped more than 21% after rallying 68% in the previous trading day, but it too shed all those gains to close almost 7% lower. China's biggest chip maker, SMIC, retreated from a 2-month high, losing 7.6% after some US lawmakers suggested greater curbs on the company over concerns it may have circumvented US trade sanctions in making the chip inside Huawei's new Mate Pro smartphones. SMIC's peer, Hua Hong Semiconductor, slid 5.8%. Here in local markets, there is a black rainstorm warning in force. That means the opening of the Hong Kong Stock Exchange is going to be delayed, and if that black rainstorm warning is still in force at 9 o'clock, then the whole morning session will be cancelled. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And to welcome our guests, we have with us in the studio John Schofield, who is Managing Director at Tempus Investment. Morning to you, John.
Yes, hello, good morning. Good morning. Rainy morning.
And also with us, we have Sunil Kashyap, who is Director of Finmet. Morning to you, Sunil.
Good morning.
China reported Thursday another monthly decline in imports and exports, albeit less steep than expected. Exports from China dropped 8.8% year on year to $284 billion in August. That's after a 14.5% plunge in July, but it was better than forecasts of a 9.2% fall. This was the fourth straight month of decline in exports amid weakening global demand. Exports have fallen year on year for every month since April as global demand for Chinese goods waned. And shipments to ASEAN, which is China's largest partner, fell 13.3% compared to a year earlier. Exports to the European Union dropped almost 20%, and shipments to the United States dropped for the 13th consecutive month, falling 9.5%. And imports to China, they declined by 7.3% compared with market estimates of a 9% drop. And after a 12.4% plunge a month earlier, and imports have now fallen every month in 2023 from the year ago period due to persistently weak domestic demand. John, what are your thoughts on this? And in particular, what's it telling us about, I suppose, both the state of the domestic economy on the mainland and also the global economy?
Well, I think part of the the currency. We know that China's been obviously the currency is weak, but also the price cutting on a lot of goods. So some of it, in volume terms, I suspect the decline is not that big, but in US dollar terms, obviously. I mean, we've still got a humongous, and this is a sense of the problem, there's still a huge trade surplus from China. The balance of payments, hundreds of billions every year.
It's about 1.5% of GDP, I think, isn't it?
Yes,
which is massive.
And if you annualise it, it is massive. So, on the one hand, we've got the very weak domestic economy. On the other hand, we've got the mercantilist side of the economy, which is both of which, in a sense, have reached limits to growth, in my view, on a long-term view. Obviously, we've got the debt crisis, which signals an end really to the investment-led, savings-led growth in GDP. We've yet to see how that's going to work out. In the meantime, we've got the impending, the decoupling, the de-risking, increasingly pushback. I think we're going to see from Europeans in particular to this flood of cheap motor vehicles, amongst other things, which are clearly challenging the German economy in particular.
I've got those numbers now on the trade surplus. In fact, I was too low. China's trade surplus is equivalent to 5.5% of GDP and about 1.2% of the rest of the world's GDP. So they are enormous numbers, aren't they? Yes,
I mean, so we're getting into, as I say, in territories where the sort of natural limits to growth have to kick in somehow. How can the rest of the world absorb all this stuff?
Sunil, what are your thoughts? I mean, just mentioning on that trade surplus, it's enormous, isn't it?
It is. I mean, and it just shows that China continues to be the factory of the world, sort of. I think what is, in terms of some of the numbers of declining exports, what's actually happening is there's a change in the way manufacturing in terms of the supply chain is working out. What seems to be happening is there's a lot more products being exported from China, maybe semi-finished products from China to the Asian countries, to places like Mexico and Latin America. And then those products get completed in terms of manufacturing in those markets and then get exported to Europe and the US under the logo of made in Mexico or made in Thailand or Vietnam, etc. So because the last 10-20% of the product is the value added is done at that third country location, the exports from China have reduced in nominal terms. And if you look at the pattern of exports also, it's changed, right? The US is not the biggest trading partner anymore for exports. It's Asian countries. And also exports to Mexico have increased quite a lot. So I think all in all, some of the decline is because of that offshoring of some of the supply chain value addition.
On that point you made about where these exports are going, there was a report on Wednesday by the US Census Bureau. It showed China's share of US goods imports fell to the lowest level since 2006 in the year through to July. So as American companies, they seem to be reorientating away from Chinese suppliers. Yeah. So that's really,
and Mexico's share has gone up. And Mexico's share has gone up.
I think that's gone up to a record high, in fact. So there is a real change going on, isn't there?
That's right. There's a change. But then the interesting thing is, if you dig deeper, a lot of the manufacturing in Mexico or in Vietnam and Thailand is being done by companies owned by Chinese entrepreneurs. So ultimately what they're doing is just shifting part of the production cycle to other countries.
Yes, that's what we've seen. We've seen figures saying that exports to those ASEAN countries have increased quite dramatically. That's been, as you say, the real cause of that is not demand from those countries.
I'm trying to look at this data. It's a sort of good news, bad news thing, isn't it? I suppose the good news is that trade is sort of contracting at a slower pace, although it's still going down. It's not going down as fast and maybe better than expectations. The bad news, though, is that it does still continue to contract, and it's not good news overall for the economy.
Yes, as we see from the latest thing with Apple and so on, the lack of reciprocity by China to for foreign manufacturers in China and other businesses is going to lead to further decoupling, and this is a long-term trend, I'm sure.
Sunil, I'm wondering how much external demand is going to play a factor here going forward. Do you think China's tempted, because it's struggling to get domestic demand going, is going to try and instead rely on, once again, becoming the factory of the world and exporting overseas? But is it going to struggle, given that overseas demand is not particularly strong either, is it?
Yeah, I mean, I think there's 2 points there. Firstly, let's look at the domestic demand. I mean, that's the biggest concern for the government. I mean, for over the last 4 or 5 years, even during COVID, they've been trying to pivot away from being an export-led economy to being domestic consumption-led economy in services, etc. And while there was some growth around the time of COVID or before COVID, what we've seen after that has been very disappointing. And then there's a real crisis of confidence taking place amongst the Chinese consumer, because they can see, the obliteration of stock prices, real estate prices, all kinds of asset pricing deflation is taking place. So that is an issue. The lack of domestic demand is an issue. And now, what does the government focus on? I mean, do they start ignoring that and try to focus on the export side at a time when the world seems to be entering into a slowdown? I think it's a major challenge for them. It's something they can't control. I mean, the only way they can control is maybe reduce prices, use the devaluation of their currency, and try to push product. But at this time, the mood in the world towards China is not as positive as it was, for example, in 2013-14. And so it's going to be more difficult for the Chinese exporters to win back market share.
The mercantilist model has also reached its limits. So I'm not sure that the government is really making that much effort to stimulate, consumer demand. As you say, Sunil, quite rightly, it's very difficult in this environment with the debt crisis and so on. And the only way around that is to really start printing money, and part of that does involve devaluing the currency and trying to get cash flowing through the. But structurally, with only 38% of GDP being due to the consumer, which is barely half what it is in the United States, for example, it's very difficult to get that growing. Once you've got a low base, so once you get a sort of circle. A virtuous circle in it could recover quite quickly, but then again you come against the philosophical problems the party have. They don't want a consumerist type society, and they don't want to provide a social welfare net. As well known that Xi Jinping is against that kind of thing. So with that background, what they can do in practical terms is necessarily limited.
Sunil, do you think this plays into the Fed's thinking at all? Because it must have a bit of a dilemma at the moment, because the US economy is looking pretty strong, isn't it? We saw that ISM services data yesterday, which was better than expected, but it's now facing a Eurozone that looks like it's going to slip into recession, a Chinese economy that's looking quite weak and is facing the problems of really weak domestic demand. Does this influence the Fed?
Yeah, I think it will. I think, and also if you look at the central bank action of a lot of the central banks around the world, Australia recently, New Zealand earlier, everyone's keeping their local interest rates on hold. And I think that's a recognition of the fact that a lot of the central banks around the world feel their own economies have sort of peaked, and therefore they don't want to risk further increases. So I'm quite positive that Fed's going to keep that in their mind. I think the local price inflation and local recent data has been positive in terms of pushing people towards thinking about the Fed increasing rates. But I think the overall picture, and certainly China, gives them, quote unquote, an excuse to not to raise this time in September, and it's going to play into their thinking in terms of what they do long term, because the US dollar interest rates are really now quite high compared to the rest of the world.
Yes, I think that's where it's showing up. US is uniquely positioned really, because it's got all its own resources, self-sufficient, particularly in energy these days, and there are, for some reason, the crude oil prices, as you know, has rallied quite a lot in recent weeks. To what extent that's manipulation by Russia and Saudi and OPEC, who have a declining share of the world market, remains to be seen. But there are there's still residual inflation effects in Europe, UK, for example, and but on the Fed, it seems to be coming down quite quickly, despite these robust job data. So I think it's finally balanced for the US. I agree. They may well hold in September at least, and see how things go.
Sunil, a question I've been asking all week: why is China avoiding using its big bazooka to go and spur the economy in maybe the way that it did after the global financial crisis, where it really did step in big time, didn't it, to stimulate domestic demand and to stimulate the economy? It seems very, very reluctant to do that this time around. Why is that?
The fear is that you use the bazooka and it has unintended consequences. I think this particular regime is very careful about controlling the way the economy and the society moves forward, and using a bazooka to create situations like local service demand or a sudden skew in money supply will create social unrest, and so that's why that's the last thing they want. So I think in this situation, economics is taking a backseat towards compared to politics, or compared to the parties' sort of view of keeping control of what happens in the Chinese economy.
Yes, indeed. I think a lot of commentators have pointed out that the previous bazookas were really directed at the investment-led growth model, so just increasing fixed asset investment. Obviously, in the case of property, that's now at a complete dead end. Even in terms of the infrastructure, they've built out as much as they can. And the incremental gains from further, road and railway buildings are very limited at the margin. That's the only one hopes to see over time is a gradual shift away from fixed asset investment towards the consumer and household income generation. But that's, as I say, the politics seem to be getting in the way of that at the moment.
Now, shares of Apple fell 3% Thursday after a 3.6% drop Wednesday. That's the most in a month after reports that China had ordered officials at central government agencies to not use iPhones and other foreign branded devices for work. Employees at some Chinese central government regulators received instructions to stop bringing the gadgets into the office, according to the Wall Street Journal. And the directive is the latest step in Beijing's campaign to cut reliance on foreign technology and enhance cybersecurity. And it comes as China seeks to limit flows of sensitive information outside of China's borders. And Bloomberg News reported yesterday that China plans to expand the ban on the use of iPhones to government-backed agencies and state-owned companies. And the move by Beijing could have a chilling effect for foreign brands in China, including Apple. The iPhone maker dominates the high-end smartphone market in the country and counts China as one of its biggest markets, relying on it for about 19% of its overall revenue. Sunil, this is a problem clearly for Apple, but also it's more worrying overall, isn't it, in that it just seems that the protectionism of not just China but the US to protect their own markets, to put restrictions on trade, just seems to be getting worse.
Honestly, I agree. But honestly, I'm surprised it took them this long. If you think back, they started with the U.S. Telling all government officials and congressmen, senates, etc., saying that they should not have TikTok on their government phones, right? And at that time, China didn't react. So, this has been going on. It actually started a lot from the West, and so China is just reacting to that. So I'm not surprised by it. I think it's it's just an escalation of the situation of the decoupling that we've been talking about, or de-risking, and so it is what it is. It's to be expected that China would react in this way.
Yes, but haven't China also put a lot of restrictions on software tech, US software tech in China? Well, but anyway, you're quite right. So we're in a sort of tit for tat kind of situation, I think, here. I'm not.
So much so difficult is because while Google was restricted, Apple was not, and a lot of the information that people use on Apple phones is kept on the iCloud, and that's where the US, because of the US government laws, would have access to the information on iCloud for national security purposes. So I think. It is to be expected. It's not unusual that you would, in this environment, government would do that.
But yes, it's also not helpful for Chinese, employment in China. Obviously, Apple have to start cutting back production and things like that. So, yeah, it's all part of this, this ongoing, de-risking. I suppose in this sense you could say it's de-risking in terms of the digital space.
I suppose, Sunil, I know you say you're not surprised by this, or at least surprised that it hasn't happened earlier, but the one thing is that, there are large American companies like Apple that don't share the same fervour that the Biden administration has for putting restrictions on trade. And Apple in particular has been a very big investor in China, one of the biggest. It employs a lot of local Chinese people at its factories. And it's sort of like, been doing what Beijing has been asking companies to do, which is to sort of act independently of their government. So are you a bit surprised that, they've done this to Apple, which is, could backfire on it?
Yeah, I understand. I think that's why it took them so long to come up with the decision. But as of now, what I understand is it's restricted to government devices and government officials, right? So what may happen in reality is that some of the government officials may keep their personal devices as iPhones and then have a separate device, which is a local device for the government uses. So, I know that it's something that they must have pondered over, but I think honestly for their own national security, it's to be expected, because there have been cases and they've been documented in the last couple of years where the devices of some Chinese government officials, iPhone devices, have been seized by the Western agencies, and information has been downloaded from that. So I think the Chinese government does have reason to be concerned for its own security purposes and to implement this. And remember, it is for government devices and government officials using it for official purposes.
But if it gets extended, as Bloomberg is reporting, to state-owned enterprises, that's a real big step up, isn't it, on the restrictions?
Correct, and knowing what China is, you'll have maybe some private sector who may show their nationalistic colors and say we were implementing the same ban. So I agree that the impact on Apple is going to be considerable, but given the environment we're in, I think it's to be expected. What may happen is you may have a negotiated settlement where the U.S. government steps down in some of its restrictions on TikTok and other Chinese tech companies as a quid pro quo, China doing the same for iPhone. So you may get into those kind of situations. Yes,
that's a thought. Certainly, if 50% of the Chinese economy is not allowed to use Apple, that will be a big restriction. Perhaps they could somehow do a sort of firewall in the sky and have all data from Chinese sources was stored on a cloud, accessible to the Chinese government.
That's a novel idea, a firewall in the sky. Apple's got another threat, though, at the moment, hasn't it? This is coming from Huawei. Their new Mate 60 Pro, which is Pro phone, which has just sold out, been selling like hotcakes, has very high-speed capabilities, download speeds of 500 to 800 megabytes. So you can basically download a movie in high definition. People are wondering where Huawei got the chips to be able to do this, and it looks like they came from SMIC, which means that SMIC is really finding ways of circumventing these trade restrictions from the US. But this is quite interesting, isn't it, John? Because it basically, this new phone that Huawei has developed isn't subject to sanctions, has nothing to do with Taiwan's semiconductor manufacturing, nothing to do with any Western semiconductor tool manufacturer, nothing to do with US patents. It really is a homegrown phone.
Well, some of the restrictions on exports to China haven't even come in yet. I believe they're about to. And there was reported a surge of imports, surge of demand for chip producing equipment from the West, I presume, from ASML and people like that, earlier this year. So I think they've been able to build up the equipment and the expertise in using it to this extent. What is it? 7 nano. slightly out of my depth here technically, but I believe that Apple and so on are on to 3 nanos. And the question is, so the idea is that they won't be able to get their hands on the very latest equipment from now on that would enable them to get to that step. But it's probably very porous.
Sunil, what do you make of that? I mean, is maybe these sanctions on high technology, China's getting around them much quicker than people thought, and it's not going to put their development back as much as the Biden administration was hoping for?
Yeah, I think we've seen sanctions are quite a blunt tool. So, and they, not all countries around the world, industrialized countries, are 100% behind the U.S. sanctions on China. So you do have leaks taking place. So I think that's going to be expected.
Finally, let me get thoughts from both of you on the markets. Couple of big things going on at the moment. First of all, oil above $90 a barrel, or it did fall back a little bit overnight, but earlier this week hit $90 a barrel. Also, the weakness in the Chinese yuan at a 16-year low. I mean, first of all, John, on the oil front, how big a problem is this? Oil heading to $100 by the looks of it.
Well, I'm not sure about that. It's surprising. Normally, what happens when OPEC cuts production, somebody else steps up and steps up to the plate and increases production. I'm not sure why that hasn't happened yet. Maybe there's still lags, because of the decommissioning of rigs. But it's probably more important to focus on the gas price, the Henry Hub natural gas price, which is now at very cheap levels to $2.50 and between $2.50 and $2.80. Compared with $10 or more during the COVID pandemic, and that's where the US, of course, comes in, because the US fracking and so on. They're producing plenty for the US market and increasingly for export, including to Europe. But it's obviously still it's a short. So I suspect it's a blip. This blip in the crude oil price, but you never know. It is going to be a problem. Again, the inflation data in Europe and the UK is not going to maybe not come down as fast as it was expected to do. Gasoline prices in the UK have reported to have jumped, I think 20 or 30%. Just in the last couple of months.
Sunil, how big a problem is $90 a barrel?
Yeah,
oil?
it's a problem. It's a problem, I think, but I agree with John. It's going to be a blip. I think you have to wait for the demand side to react to this, and this is going to be a trigger, I think, for a lot of people to just tighten their belts. So demand is going to come off substantially because the mood overall in the West, especially in Europe and in the US, on the ground amongst the consumer is not so positive. Customer confidence is quite low. So I think this is just going to be a trigger where people say, okay, fine, I have to now really take steps to reduce my usage of gas and reduce my energy needs. And so you're going to see a reaction. It'll just be delayed a bit, but the demand side is going to come off.
And Sunil, let me ask you also about the currency. The US dollar on track for now the 8th week of gains. The Chinese yuan sinking towards a 16-year low. Slightly surprising, the strength of the US dollar, in the sense that, it's widely expected that the Fed is going to be on hold later on this month. But I guess this is reflecting the fact that the US economy looks like it's doing far better than both the Eurozone and the Chinese economy.
Yeah, and also the data recently has been pointing towards as higher strength, and so maybe the Fed may increase. So that kind of rumors have come in, but like we discussed, I think it's unlikely the Fed's going to do that. I think the Fed is going to announce that they're holding steady for now, and so this dollar strength, which has come in the last week, in this week actually, is going to come off a bit. It's because the dollar strength is across the board, across all the currencies, and I think it's going to come off. It's just been a initial sort of effervescence after seeing the good data of this week.
Yeah, I think on nevertheless, in the long term, the fact that investors can get a much better return on their money, whether it's in equities or in bonds now, is a long-term bullish factor for the US dollar. I'll also point out we still haven't reached levels that we reached last, I think it was October, wasn't it? The previous dollar rally. We're still some way below those, and everything that's happened since then only emphasises the relative strength of U.S. Financial markets, economy, and therefore the currency. The interest rate differentials have narrowed a bit in some places, particularly with Europe and so on. But it looks like that interest rate differential is going to be maintained, and particularly against the Japanese yen. Well, how can you possibly argue for a stronger yen when the interest rate differential is 5%?
Okay, well, thank you both very much. Have a great weekend. Stay safe in the black rain. That was John Schofield, who's Managing Director at Tempus Investments, Sunil Kashyap, who is Director of Finmet. I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
Now, the Reserve Bank of Australia left interest rates on hold for a third straight month. The cash rate is at 4.1%. That was pretty much in line with market expectations. Although, Toby, looking through what they said afterwards and the statement, it was a fairly hawkish hold, wasn't it? They were indicating that rates may still have to go up more.
Yeah, I think that one of the big concerns for the Reserve Bank is growth slowing. So we saw the GDP figures during the week, growth around 0.4% for the quarter, just over 2% for a year on year, and clearly a decline overall in the level of activity. But what is concerning the most is that some of the price pressures are still fairly sticky, and this is not inconsistent around the world, but for Australia, it's productivity, which is declining. And if you look at the GDP per hour worked, which is an interesting indicator of productivity, it fell like 2% quarter on quarter, quite significant. And this is the area which suggests that if your unit labour costs continue to rise, and there is some pressure on actual wages but also productivity, then it's going to be much more difficult for the central bank to control inflation and ultimately to bring it down. So I think the message from the Reserve Bank is more hawkish than possibly the economic data would suggest, and that's a function probably of structural productivity weakness that needs to be shifted.
And meanwhile, the Australian economy, as you said, it's really growing below trend at the moment, isn't it? Although GDP was advancing, it's definitely sort of slowing, and unemployment's they're forecasting that to rise as well next year.
Yeah, overall, Australia is structurally pretty sound. We say it's a bit of done luck. Australia tends to do pretty well. Now, on the horizon, of course, you've got China. The economy there is slowing, so that has an impact on the trade sector for Australia. But the other positive that's sort of structural in terms of economics is the migration numbers. So we tend to benefit, and we will continue to benefit from an inflow of population that drives GDP. So if you look at it on a per capita basis, our growth's not so strong, and potentially you could be technically in a recession. But that's somewhat mitigated by the fact that we're getting 200,000 or 300,000 people coming through the gates in the next couple of years, and that drives GDP. So structurally, we're probably got a bit of a tailwind, but productivity is definitely a concern that the central bank have identified, which suggests that they're going to keep the pressure on rates. Even if they don't raise them, they're likely to stay higher for longer.
And what are exports looking like with China? Relations have improved a bit, haven't they, over recent sort of weeks and months between the two countries. Is that being reflected? Is trade picking up? Yeah,
I think, overall trade numbers will be softer because of China's growth. But yes, there's definitely been a thawing in the relationship between Australia and China, such that even overnight announcement that for the first time in 7 years that the Prime Minister will be visiting China and visiting the President Xi. I think it's around December. I think that came out overnight in terms of news. So, yeah, definitely a thawing in the relationship. I think this is probably mutual. I think the government's approach towards China had softened with the change of government, and at the same time, China, I think, has opened up itself a little bit more to dialogue with Australia. So together, hopefully, that'll continue, and will obviously be reflected in our trade and various other elements of the relationship.
Now let's switch our attentions to the G20, which is taking place this weekend in New Delhi in India. I suppose the main news from this is the absence of President Xi Jinping, who has decided he's not going to attend and he's sent Premier Li Jiang instead to represent him. How much does this devalue the G20 or reduces the chances of anything getting done or being agreed?
Yeah, no China, no Russia means no consensus and no statement from the G20. So clearly it'll have an impact in terms of what output comes from the G20. And it fairly well aligns the separation between those countries that are, G20 solid and those that are more heading towards maybe a BRICS type alternate arrangement, and that's being China and Russia. I mean, Russia, we know, of course, impacted by their exclusion around the Ukrainian situation. But the China one is probably a reflection too of positioning by China to the extent of trying to move away somewhat of the G20. But at the same time, I think given the domestic issues in the country, it may be such that Xi wants to stay close to the domestic situation in China and not necessarily put themselves out externally. That's one factor. But clearly, there seems to be a separation between those that want to be in G20 and those that want to shift to another group.
And that other group presumably would be BRICS, which would China would like to be the leader of.
That's right, and the interesting thing is it's being held in India, and India being a foot in both camps, for want of a better expression. It's a very important time for India to show solidarity and to sort of bring the noise down and to try to be a mediator across both the West and China and Russia. So a really important meeting, but without China and Russia there, the output from a public perspective will be minimal because it needs a consensus for any statement to be delivered, and it won't happen.
This is a big moment for India, isn't it? Because I don't think there's ever been a time before where so many world leaders have been in India at the same time. And also it's a good opportunity for India to promote how its economy is doing and how its development is going. So this is quite a pivotal moment for India.
Yeah, I think it's a huge success for the political leadership of Modi. And certainly the BJP have used this opportunity of international leadership to promote, the strength of the Modi government and the strength of the BJP across India. And I think, their use of the G20, I think they've had something like 50 different states visited from various groups associated with G20. So they've really taken advantage of the publicity that gives. India is on the map. I think clearly the West wants India to be a key ally in the region. And so from that perspective, it's really a good moment for India to shine, notwithstanding that it has its own issues. And, those who criticise India can have plenty of arguments around, the sort of whitewashing of what's happening on the ground versus what they present to the world. But this is not unusual. And this is an opportunity for India to really shine across the globe.
It'll be interesting to see if India can get consensus on some things, because even though there's the friction between the US and China and US and Russia, there are things you would think that maybe they could agree on, like debt relief, climate change. Also, they want to admit the African Union to become a permanent member of the Group of 20 in the same way that the EU is. So presumably there could be some successes there, and a lot of this is going to be down to India's powers of persuasion.
I suspect you're right. I think climate change will be one. I think that they definitely can get some consensus there. Obviously, G20 supporting emerging countries and facilitation there. I think the African Union is an interesting one. I'm not sure how that'll go, but you're right. I think there will be some opportunities to show a unified stance, particularly, and I think climate change is obviously an obvious one that. With the hottest summer on record in Europe, it's very much a focus of the world. And so this will be an opportunity for G20 to show leadership.
And also it's an opportunity, isn't it, for President Biden, because with Xi Jinping and Vladimir Putin not being there, presumably he can hold out some olive branches to some of those countries that have been looking to forge closer ties with China. And I'm thinking of countries like Brazil, South Africa, Indonesia, or even India itself, all countries that also haven't really taken a position on Russia's invasion of Ukraine. Maybe this is an opportunity there for President Biden.
I think that'll be an opportunity to show it in a public forum. I think behind the scenes there's clearly been a lot of work done by the West in sort of trying to shore up those relationships and try to ensure that they're singing from the same song sheet. So, yeah, it's an opportunity for Biden to be standing shoulder to shoulder with some of these other world leaders. But as I suspect, the meeting will be one that will be limited to consensus on topics that don't necessarily create controversy for China and Russia. But you're right, it's a good opportunity for public show of, unification.
Now, let's turn our attention to the markets. A few important things going on. First of all, Apple lost 6% over the last couple of days. There's about $200 billion in market cap, although it's still got about $2.75 trillion left. But nevertheless, this news that China is restricting iPhone uses in government departments and may also extend that ban to state-owned enterprises as well is quite a big blow for Apple, isn't it? Because almost a fifth of its revenues come from China. But also, it seems to send out a bad signal that protectionism and relations between the US and China seem to be worsening.
I think they've been working on this in China for quite a while. So it's news as in, I think they've been looking to secure their communications environment internally. Somewhat similar, I guess you could say, that other nations trying to block Chinese technology at times. So it's a surprise in so much as the announcement caused the share price to drop because it hadn't been priced in, but not a surprise that it's happened. For Apple, clearly there's an opportunity to pivot into India, and there's been a lot of push from the CEO and Apple to get more presence in India. So there's one strategy to try to adapt to the changing geopolitical climate with China. That's one of concern. I think a broader measure of the relationship between the West and China, it's probably just another example, but I don't think it's new news. It's something that China's been working on for quite a while. And to be fair, so Western governments in terms of trying to block Chinese technology.
Okay, and a couple of other things I just wanted to get your thoughts on. $90 oil. Some analysts say we're going to have $100 per barrel oil. This is a headache for central banks, isn't it?
It is a significant contributor to inflation. Supply-demand impact, obviously Saudi and Russia announcing their supply curbs has done the trick. That's tricked it up over that 80 mark, and now, as you say, printing through 90. I think it has a lag effect, I guess. Although what it does is it just suggests that the ability of central banks to bring inflation back down to target is going to take longer when you have this type of move on one of the key price inputs to just about everything. So yeah, we'll be watching it closely, and it's anything through 100 then starts to get the zeitgeist and the press, and that'll be something to keep an eye on.
And what about the US dollar, on track now for its 8th week of gains? That's the longest winning streak since 2015, combined with the Chinese renminbi, which is sinking to a 16-year low. Nothing seems to be able to stop the dollar at the moment, not even the prospect of the Fed being on hold, but presumably this is coming about because of all the recent data that we've seen out of the US, which is showing the economy there looking stronger than thought.
Yeah, that's true. I think, the equity market's starting to feel a little pressure from, particularly in the growth sector, around higher rates that could happen. I think people, looking at ISM, looking at the jobless figures in the labour market overnight, it suggests that the economy's still got plenty in it, at least for the moment. And the lag impact of these higher rates hasn't necessarily hit the economy as people have expected. So there's a repricing of risk in relation to debt. And so I think in that regard, higher rates potential in the US, or at least higher rates for longer in the US, is reflecting in bond yields and also in the dollar. And of course, then against that, as you say, you've got the Chinese yuan, you've got the yen, and and the euro being an economy that's probably struggling a little bit, particularly with Germany as a lead and contributed to the softness, these all lead to stronger US dollar prospects.
Toby, thank you very much indeed. Have a great weekend. That's Toby Lawson, who is the CEO of Statton Partners.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex K.Y. Wong Asset Management, and Dickie Wong, who's Head of Research at Kingston Securities. And providing a view from mainland China will be Yanan Wu, the Chairman and CEO of Surfing Group. Have a great weekend.
Money Talk